Ladies and gentlemen, let me begin with a simple question, one that economists are trained to ask, but power would rather we didn't. Who benefits? Whenever a major financial institution makes a bold prediction, and whenever a global power quietly changes its trade policy, we must ask not what they say, but why now? Bank of America's call that silver could surge towards $65 an ounce is not just a market forecast. It is a signal. And China's decision to cut exports at this precise moment is not an accident. These are connected events in a global economic system under strain. Now, Bank of America wants us to believe this is about supply and demand, about green energy, electric vehicles, and solar panels. And yes, silver is essential to all of that. But let's be honest, capitalism never moves for one reason alone. When a major bank publicizes a dramatic price target, it is not merely informing the public, it is positioning capital. Big money moves before the headline, not after it. These forecasts often function less as predictions and more as justifications for shifts that are already underway behind closed doors. This brings us to China. China has cut exports of key industrial materials, including those tied directly to advanced manufacturing and clean technology. Why? Because China understands something fundamental about modern capitalism: control of resources is control of power. For decades, China supplied the world cheaply while absorbing thin margins. Now, as geopolitical tensions rise and Western economies scramble for strategic independence, China is saying, in effect, no more giveaways. By restricting exports, China is not just protecting its industries, it is forcing the rest of the world to confront its dependence. Here is the hook we must not ignore. When China restricts supply and Wall Street predicts higher prices, working people pay the cost. Rising silver prices don't simply enrich miners or investors, they raise production costs across industries. Solar panels become more expensive. Electronics cost more. Inflation quietly creeps in through the back door. And once again, we are told this is the market at work, as if markets were natural forces like gravity, rather than systems designed by people for particular interests. Let's be clear, this is not a story about silver alone. This is a story about a global economic order in transition. The United States built its power on financial dominance. China built its power on industrial capacity. Now those two models are colliding. Bank of America's silver call reflects anxiety within a financial system that senses scarcity ahead. China's export cuts reflect confidence that the world cannot function without what it produces. Market forecasts reflect power, not just data. Bank of America's 65 silver call should be understood as a strategic signal by financial capital, not a neutral prediction. Major banks shape expectations to position investments ahead of structural shifts in supply and demand. China's export cuts are a strategic economic weapon. China is using export restrictions to assert control over critical resources, signaling a shift from being a low-cost supplier to a price-setting power in the global economy. Resource control equals geopolitical influence. Silver and other industrial metals are no longer simple commodities. They are strategic assets tied to energy transition, technology, and national security. Rising commodity prices fuel structural inflation. Higher silver prices increase production costs across clean energy, electronics, and manufacturing, pushing inflation onto consumers rather than financial institutions. Financial capital vs. industrial capital. The silver surge narrative exposes the growing tension between U.S. financial dominance and China's manufacturing-centered economic model. Systemic transition in global capitalism. These events signal a broader transformation in global capitalism, where scarcity, de-globalization, and state intervention are replacing assumptions of endless supply and free trade. When a major financial institution, like Bank of America, announces a bold price target for silver, it is tempting to interpret it as a purely technical exercise, the outcome of models, charts, and objective analysis. But economics, especially in a capitalist system, does not operate in a political or social vacuum. Large banks do not simply observe markets, they actively participate in shaping them. A dramatic forecast functions as a message to investors, policymakers, and corporations, signaling where capital should flow, and just as importantly, where it is already flowing. Here is the first hook we must confront. The biggest players move their money long before the public hears the story. By the time a $65 silver target appears in a headline, institutional portfolios have already been adjusted, exposure has already been taken, and risk has already been distributed downward. The forecast is less about predicting the future and more about normalizing a price trajectory that benefits those positioned early. What is presented as analysis often operates as persuasion. Financial markets are driven as much by expectations as by material realities. When a respected institution speaks, it influences sentiment, and sentiment moves prices. This is not manipulation in the illegal sense. It is power exercised through credibility. Banks understand that markets respond to narratives. A strong silver outlook legitimizes higher prices, encourages speculative inflows, and attracts passive investment vehicles, all of which reinforce the very outcome being forecast. The prediction helps create the reality it claims merely to describe. Another hook worth emphasizing is this: neutrality in finance is largely a myth. These institutions have clients, positions, and strategic interests. Their research does not emerge from detached observation, but from within a system that rewards certain outcomes over others. When scarcity is emphasized, when upside is highlighted, and when downside risks are softened, it reveals an alignment with capital accumulation rather than public understanding. This dynamic exposes a deeper truth about modern capitalism. Information itself has become a tool of economic power. Forecasts guide behavior, concentrate gains, and socialize risk. When prices rise, the rewards flow upward to asset holders, while volatility and inflationary pressure are absorbed by producers and consumers. Bank of America's silver call, therefore, is not simply about where the metal might trade. It is a window into how financial authority influences markets, legitimizes redistribution toward capital, and quietly reminds us that in economics, those who frame the story often win the game. China's decision to cut exports of key industrial materials is frequently framed as a technical trade adjustment or a short-term response to domestic demand. That framing misses the deeper economic reality. In a world where global supply chains are under stress and geopolitical trust is eroding, export controls are no longer passive policy tools. They are instruments of leverage. China understands that its position at the center of global manufacturing gives it a form of power that financial markets alone cannot replicate. Here is the first hook that demands attention: control over supply is more decisive than control over prices. For decades, China allowed global markets to dictate prices while it focused on scale, efficiency, and industrial dominance. That phase is ending. By limiting exports, China shifts the balance of power, forcing downstream industries in other countries to compete for access rather than negotiate on cost. This transforms China from a price taker into a strategic gatekeeper. Another hook lies in timing. These export cuts are not occurring in isolation. They coincide with heightened demand for metals critical to clean energy, defense, and advanced technology. This is not accidental. China is aligning its resource policies with its long-term development goals, ensuring that domestic industries receive priority access while external competitors face rising costs and uncertainty. Export restrictions, in this context, function as an industrial subsidy without appearing as one on a balance sheet. The global consequences are profound. When China restricts supply, it exposes how deeply other economies depend on uninterrupted access to Chinese production. Many Western economies outsourced not just manufacturing, but strategic resilience. Now they are discovering that rebuilding capacity is expensive, slow, and politically difficult. Export cuts turn that vulnerability into immediate economic pressure, pushing prices higher and compressing margins across global supply chains. There is also a psychological dimension at work. Export restrictions send a signal that China is willing to absorb short-term revenue losses in exchange for long-term strategic advantage. That willingness alters expectations and injects uncertainty into global markets. Investors, corporations, and governments must now factor political intent into economic planning, a shift that challenges the long-held assumption that trade flows are governed solely by efficiency. Ultimately, China's export cuts reveal a broader transformation in global capitalism. States are reasserting control over resources once left to markets. Industrial policy is returning, not as an exception, but as a norm. China is not withdrawing from the global economy, it is renegotiating its terms, using material power to shape outcomes. In doing so, it reminds the world that in an age of scarcity and competition, access matters more than ideology, and production power often outweighs financial influence. The idea that silver and other industrial metals are merely commodities traded on exchanges is increasingly detached from economic reality. In the current global landscape, these materials function as strategic assets embedded in national security, technological leadership, and long-term economic planning. The moment a resource becomes essential to energy systems, digital infrastructure, and military capacity, it ceases to be neutral. It becomes political, and control over it becomes a form of geopolitical influence. Here is the first hook we must confront. Nations no longer compete only with armies and currencies, they compete with supply chains. Silver sits at the heart of solar technology, advanced electronics, medical equipment, and defense applications. Whoever controls consistent access to this metal controls the pace at which others can innovate, electrify, and modernize. This is why disruptions in supply resonate far beyond mining markets and into the strategic calculations of governments. Another hook emerges when we examine the asymmetry of dependence. Countries that dominate extraction, processing, or refining possess leverage over those that rely on imports. This leverage does not need to be exercised loudly to be effective. The mere possibility of restriction alters bargaining power, investment decisions, and foreign policy behavior. When access to critical materials becomes uncertain, entire industrial strategies must be re-evaluated, often at significant economic cost. This shift has profound implications for the global economic order. Free trade assumed that resources would move smoothly across borders in response to price signals. That assumption is breaking down. States are increasingly willing to intervene, stockpile, restrict, or redirect materials in pursuit of strategic goals. Markets may still set prices, but governments increasingly determine availability. This represents a structural change in how economic power is exercised. There is also a financial hook embedded in this transformation. As metals acquire strategic value, they attract speculative capital seeking protection against geopolitical risk. This financialization amplifies price volatility, further entangling markets with politics. What appears as a commodity rally is often a reflection of global anxiety, a hedge against instability rather than confidence in growth. Ultimately, the reclassification of silver as a strategic asset exposes a deeper truth about modern capitalism. Economic strength is no longer measured solely by GDP or financial flows, but by control over the physical inputs that make economic activity possible. In this environment, access becomes leverage, scarcity becomes strategy, and materials, once considered mundane, are elevated to instruments of power that shape alliances, rivalries, and the future trajectory of the global economy. Rising commodity prices are often celebrated as signs of economic vitality, signals that demand is strong and markets are functioning efficiently. But this interpretation overlooks a crucial structural reality. Commodity inflation rarely distributes its costs evenly. When silver prices rise, the effects ripple far beyond trading desks and mining companies, embedding themselves quietly into the everyday cost structure of the economy. This is where inflation stops being an abstract statistic and becomes a lived experience. Here is the first hook that deserves attention. Inflation does not arrive loudly. It seeps in through production chains. Silver is a key input in solar panels, electronics, medical devices, and industrial equipment. When its price increases, manufacturers face higher input costs. Those costs are rarely absorbed by corporations indefinitely. They are passed along incrementally and often invisibly to consumers in the form of higher prices, reduced quality, or delayed innovation. Another hook lies in who is insulated from these pressures and who is not. Large financial institutions and asset holders often benefit from rising commodity prices through investment gains and inflation hedges. Meanwhile, producers operating on thin margins and households whose wages lag behind price increases experience a decline in real purchasing power. This is not accidental. It is a structural feature of an economic system where capital is better protected than labor. The clean energy transition exposes this contradiction even more sharply. Silver is essential to solar technology, yet rising silver prices increase the cost of deploying renewable infrastructure. What is framed as progress towards sustainability becomes more expensive precisely because markets reward scarcity. The irony is striking. The materials needed to address long-term global challenges become bottlenecks that intensify short-term economic inequality. There is also a policy hook embedded in this dynamic. Central banks typically respond to inflation by tightening monetary conditions, raising interest rates to suppress demand. But commodity-driven inflation does not originate from excessive consumer spending. It originates from constrained supply and strategic control over resources. Monetary tightening, therefore, risks slowing employment and investment without addressing the root cause of rising costs. Workers pay twice, once through higher prices and again through weaker labor markets. This pattern reveals a deeper truth about modern inflation. It is not merely a macroeconomic imbalance, It is a distributional outcome. Commodity price increases transfer wealth upward while dispersing costs across society. Silver's rising price is not just a market signal, but a mechanism through which structural inflation is embedded into the economy, reinforcing inequalities and reminding us that, in capitalism, price movements are never just about economics, they are about power. So when you hear about a $65 silver forecast or a sudden export restriction, do not treat them as isolated news items. See them for what they are: warning lights on the dashboard of global capitalism. They tell us that resources are tightening, power is shifting, and the old assumptions no longer hold. The real question is not whether silver will hit $65. The real question is this: who will control the wealth created by that silver, and who will be left paying the price? That ultimately is the economic debate of our time.